Thank you, Mr. Chairman. Chair Yellen, good morning.
Good morning.
Thank you for being here this morning.
Thank you.
I'd like to change the conversation a little bit and talk about the insurance industry and the SIFIs and its impact on places like South Carolina, where we have about $354 billion of life insurance in place. As we think through the transferring of risk that the insurance industry provides, I think it's a very important consideration. I'm a bit prejudiced in this area because I've spent 25 years in the insurance industry and appreciate the fact that until the insurance company shows up, the ability to transfer risk is non-existent. So the importance of how we impact the insurance industry through the Fed, I think, will reverberate throughout the economy. I take very specific interest in the impact that the Fed may have on regulating the insurance companies now that have been designated systemically important by FSOC. And my thought is that last year, I believe it was, the President signed a law that clarifies that the Fed need not impose bank-like capital standards on insurance companies under its supervision. I think this is for very obvious reasons. When you look at the activities of banks, the loans and deposits, comparatively speaking, to the long-term risk that most insurance companies are holding their assets for, it's important to have that delineation and take a very different approach to insurance companies than we do other financial institutions. I know from experience that this is an important consideration. I guess my question to you is, what expertise does the Fed have or plan to acquire as it begins to supervise insurance companies, and how closely are you working with state insurance regulators?
So my answer would be that we have acquired expertise. We have hired individuals who have experience in the insurance industry and are trying to build our expertise there. We consult closely with the NAIC and with state insurance regulators and the Federal Insurance Office. We are gaining experience because we are now in our 4th annual supervision cycle of savings and loan holding companies, many of which, some of which have significant insurance activities. And of course, where several insurance companies have been designated as SIFIs, and we're supervising those as well. We are taking the time and doing the work that's necessary to understand their unique characteristics and fully plan to tailor our supervision and capital and liquidity requirements for those insurance companies to make our supervisory regime appropriate. There are very important differences between the risks faced by insurance companies and banking organizations. We have undertaken a quantitative impact study and are actively engaged in working with the firms we'll be supervising to understand the unique characteristics of their banking, of their operations before promulgating a supervision regime.
Thank you. You've answered my third question as well, so I'll just go to the second question at this point then. Will the Fed issue an advance notice of proposed rulemaking before issuing proposed rules on insurance capital standards then?
Yes, we will issue proposed rules. We recently issued a proposed rule that pertains to our supervision of GE Capital, and we would do the same with the other firms.
Thank you. On the issue of stress tests, I know that the Fed is, through the supervision of bank holding companies and other non-bank financial companies, the Fed conducts stress tests to determine how well the entity could withstand different levels of financial distress. The Fed currently has on its balance sheet about $4.5 trillion as a result of the QE program, much larger, of course, than any of the financial entities it regulates. But it appears that nobody is stress testing the Fed. The proverbial fox is guarding the hen house from my perspective. So my question really is, as you begin to unwind the Fed's massive balance sheet, hopefully in the near future, what assurances can you give this committee that the Fed will stress test its own QE exit plan?
Well, with respect to our balance sheet, let me say that we do stress test it, and we have issued some reports and papers where we describe what stress tests would look like when there are interest rate shocks, how that would affect our balance sheet and path of remittances. But it really is important to recognize that the Federal Reserve is not identical to an ordinary banking organization. First of all, capital plays a very different role in a central bank than it does for a banking organization. Congress and the rules put in place regarding our capital were never intended to make our capital play the same role, and it's not necessary for it to play the same role as in a banking organization. Importantly, unlike a bank, the Federal Reserve's liabilities are mainly reserves to the banking system and currency, and these are not like the runnable deposits of an ordinary banking organization. So the risks that the Federal Reserve faces in our balance sheet are of a different character than those facing an ordinary bank. But that said, we do look at the likely consequences for our balance sheet of different interest rate scenarios.
Certainly very different scenarios between the Fed and the banks without any question, but $4.5 trillion in the way that you wind it down would reverberate throughout the economy in a way that no other financial organization would have impact, and the path forward is incredibly important to the economy.
That's one reason that one of the principles of our normalization plans is that we want to wind down our balance sheet in an orderly, gradual, and predictable way. And we've decided to use as our main tool of policy when the time comes for normalization something that is much more familiar both to us and to markets, and that is variations in short-term interest rates. You know, of course, an alternative to that would be to say when the time comes to want to tighten monetary policy, we could begin to sell assets. That would be another way of going about doing business. But we have more experience, and markets have much more experience with variations in short-term rates, and we want to proceed in that way that's familiar to us, familiar to market participants in the public, and to let our balance sheet play a passive role to gradually diminish in size, mainly through ending reinvestment of maturing principal.
Thank you.
Senator Warner.